rolling wars. The global landscape is currently defined by a rolling war that continues to relentlessly test market resilience. The US-Iran skirmish has seen a sharp re-escalation, tearing up the recent. President Trump declared the ceasefire over, initiating fresh US airstrikes while Iran retaliated against US-allied Gulf states. Given the situation, the oil prices found a bottom, but the spike is missing, rather a start of consolidation. Many oil traders and other investors were caught in the bullish stance with oil price returning to pre-war levels. However, a secondary and potentially more insidious supply shock is worsening in Russia. Systematic drone strikes against Russian oil refineries have severely disrupted domestic fuel supplies, actively impairing agricultural machinery during the critical peak harvest season. As the world's third-largest grain exporter, these localized disruptions pose a severe threat to global agricultural markets and could reignite food price inflation worldwide. Against this volatile backdrop, the macroeconomic agenda is heavily packed. This week, June's US CPI and PPI prints will be decisive for Federal Reserve policy expectations, particularly following May's elevated 4.2% headline CPI and 6.5% PPI readings. We are also closely watching June retail sales and initial jobless claims, which continue to indicate durable consumer demand. The Q2 2026 earnings season, expectations and Wall Street consensus. The Q2 2026 earnings season officially kicks off this week, led by Wall Street banking giants like JP Morgan, Citigroup, Goldman Sachs, and Morgan Stanley. Expectations are sky high, with consensus estimates pointing to a phenomenal 23.3% to 23.7% YOY earnings growth for the S&P 500 index. Wall Street's biggest firms offer a wide but generally constructive range of forecasts for how this earnings momentum will shape the rest. Ed Yardeni remains one of the most bullish voices on the street, maintaining an 8,250 year-end target and suggesting we are in a new cycle of corporate prosperity. He notes that forward earnings are converging toward a $400 plus estimate, though he cautions that Q2 expectations are so elevated that merely matching them might cause temporary swoons, inviting dip buyers rather than massive rallies. Goldman Sachs, targeting 8,000, points out that the impressive 21% S&P 500 return over the past 12 months has been driven entirely by earnings rather than multiple expansion. They expect AI capital expenditures and related beneficiaries to drive roughly half of the 2026 earnings expansion. Furthermore, investment banking revenues are a massive tailwind this quarter. Firms are reaping the rewards of a resurgence in mega mergers and historic underwriting fees of the year. We can only comment that we highlighted this aspect in our previous paper. The earnings are growing faster than the overall market, helping drive down the market P/E ratios. Nonetheless, the markets are almost priced for perfection, and even a slight cough from a major AI theme participant would correct markets heavily. Morgan Stanley is also keeping a close eye on the consumer sector, suggesting that household resiliency has been underestimated. Taking a slightly more guarded stance, JP Morgan explicitly warns of flash crash risks associated with crowded momentum positions, emphasizing that unmanaged risk around sticky inflation and geopolitical shocks is the true enemy this season. UBS similarly anchors the moderate consensus, agreeing that the market has room to run if earnings deliver, but acknowledging that investors are paying a steep price for corporate profits at current tech valuations. Conclusion: the global market is at an inflection point. While geopolitical friction, rolling supply chain disruptions, US-Iran flare-ups, Russian infrastructure strikes, and macroeconomic uncertainties linger, the primary market driver is shifting to earnings. While we are not in a bubble territory yet, the players develop some anxiety. We go with the sector rotation crowd as the S&P 493 XMAG 7 is doing just fine for now. It's correct that the biggest margins are in the MAG 7, and we would not point to MAG 7 overvaluation, but we would point to a fatigue and to the fact that other sectors are heavily undervalued given the growth in profits. The sustainability of this bull market now relies on the small and mid-caps and value sectors. We do not rule out the MAG 7 completely, or AI theme major players, we would consider to overweight at a decent discount.